A city smaller than many airports that yet competes in the Economic Champions League. That's Singapore. People joke it runs on hawker food, order, and orchids, but the real fuel is a tax system. Systems so clear that founders, CFOs, and even sleepy auditors can follow it without a meditation app. What makes Singapore unique? The headline everyone quotes, company income tax is 17%. 17 looks low next to many countries, and in practice it often lands even lower for smaller and younger companies. Why? Because Singapore gives new and modestly profitable businesses a head start. Think of it like training wheels for your P&L. In the first 3 years of a qualifying startup's life, a large slice of the first 200,000 Singapore dollars of profit is effectively sheltered. Frankly, most of the first 100,000 Singapore dollars isn't taxed at all, and half of the next 100,000 Singapore dollars isn't taxed either. Even if you aren't a brand new startup, there's an ongoing partial exemption on the first chunk of profit each year. The result is that many early-stage companies see an effective rate miles below 17%. Of course, training wheels don't work on a bicycle that isn't moving. You need real activity, clean books, and genuine profits. Losses are used before exemptions. Paper shuffling to multiply reliefs across shell companies will not end well. In Singapore, friendly to business and serious about compliance happily coexist at the same coffee table. Now the part that makes international founders breathe easier. Singapore taxes on a territorial basis. Imagine you have two piggy banks. One says Singapore, and the other says rest of world. Money you earn inside Singapore goes into the Singapore piggy bank and is taxed here. Money earned outside Singapore sits in the other piggy bank and generally stays outside the Singapore tax net, unless you pour it into Singapore. That pouring is called receiving in Singapore. Even then, the law lets you keep many foreign streams tax-free through a regime called the Foreign-Sourced Income Exemption. Put simply, if a foreign dividend or branch profit has already been taxed abroad at a normal rate, and it makes commercial sense for your Singapore company to bring it home, Singapore often says, fine, we won't tax it again. If those tests aren't met, Singapore still gives foreign tax credits, which are like coupons you apply so you don't pay twice on the same dollar. The plot thickens around the question, what counts as received? Sometimes you can route cash directly to investors or a depository outside Singapore, and if it never touches Singapore financially, you may have no Singapore tax event. Magic? Not quite. It's plumbing. And just like any plumbing, it only works if the pipes, the documentation and money flows, match the blueprint. But what really holds companies and investors are dividends. Singapore runs a one-tier system, which means profits are taxed once at the company level, and then set free. When a Singapore company pays a dividend, the shareholder doesn't get taxed on that dividend again in Singapore. There's also no dividend withholding when money leaves Singapore, whether the shareholder is local or foreign. This keeps capital moving like a clean, well-oiled elevator, up, down, across, without extra squeaks. Of course, other payments do squeak. Interest and royalties paid from Singapore to foreign companies often face withholding. Around 15% for interest and 10% for royalties if there isn't a treaty helping you. Treaties can soften those edges, but dividends? That elevator keeps gliding. What about people? Founders, engineers, and the brave souls in finance? Personal taxes are designed to be competitive and understandable. If you live in Singapore at least 183 days in a calendar year, you're usually a tax resident. Residents pay progressive rates, yet the top step is still lower than you'll find in many big economies. Non-resident employees typically face 15% on salary, or the resident scale if that produces a higher number, while most other non-resident income has a simple flat rate. The part that makes stock option dreams sparkle is that most capital gains aren't taxed. If you're an investor selling shares, there's generally no capital gains tax. If you're running a trading business, flipping assets for a living, different story. But for most founders and individuals, gains aren't the villain here. Running a company from Singapore also means minding where control and management happen. Where does the board meet? Who signs? Where are the real decisions made? If you claim Singapore residency for the company, make sure the brain and the hands are here, not just the business card printer. Now, the sales tax you see on receipts. GST is Singapore's version of VAT, and it stands at 9%. If your business crosses the registration thresholds or is required to register, you collect 9% on most local sales and pass it along to the tax authority, keeping careful accounts. Many overseas sellers of digital services into Singapore must also register and charge GST. If you issue invoices, make sure you're using the correct rate after the 2024 change. In 5-year-old speak, every time you sell a cookie, you add a tiny extra crumb for the government and keep a tidy count of crumbs. Put those pieces together and you see why startups love starting up here. In your first 3 years, if you qualify for the startup exemption, the first profits can be feather light. After that, the partial exemption keeps your shoulders from slumping. Combine that with the territorial system and you get a powerful mix. Build your product in Singapore with a friendly early tax bill, run foreign subsidiaries where it makes sense, and bring money into Singapore on a timetable that respects the rules. With the foreign-sourced exemption or credits, you can avoid taxing the same profit twice. When it's time to pay dividends out of Singapore, there's no extra dividend tax and no dividend withholding snagging your sleeve. The catch, because there's always one, is substance. Substance is the grown-up word for real. Real people, real decisions, real records in Singapore. Shell games won't survive the sunlight here. Foreign income raises a question that founders ask in whispers. If I never bring the money into Singapore, do I avoid tax here forever? Often yes, because that's how a territorial system works. But 3 truths keep the story honest. First, foreign money left abroad generally isn't taxed by Singapore. Second, if you do bring it in, the exemption or credits often protect you if the facts line up. Third, a newer rule, often called Section 10L, can tax certain foreign gains when they're brought into Singapore if your local company has thin substance or if the gain relates to certain intellectual property. Think of that rule as a polite but firm sign on the door. If you book shiny capital gains outside and then try to carry the suitcase through Changi with no real presence at home, customs may want a word. The fix is simple. Pair the suitcase with a real office and real decision makers. Outbound payments are where many otherwise serene finance teams start pulling spreadsheets at midnight. Remember the calmness around dividends? That calm doesn't automatically extend to other payments. Interest paid from Singapore to foreign lenders can trigger withholding unless a treaty trims the rate, and royalties or fees for know-how can be similar. Certain services performed in Singapore for foreign parties can also be taxable. The rule of thumb is to withhold at source, file the forms, and pay the tax to IRAS on time. The simplest way to think about it with kid logic: when you pay someone far away for lending you their toy or letting you use their secret recipe, Singapore sometimes asks for a small slice first. If a treaty says the slice should be smaller, you show the treaty and slice less, but you still slice. If you run a truly big group, like a global revenue of 750 million euros or more, there's a new character in the story, arriving for financial years, starting January 1st, 2025. It's the global minimum tax project called Pillar 2. Its goal is to make sure very large multinational groups pay at least a 15% effective tax on their profits worldwide. Singapore will apply top-up rules so that if your big group's effective rate in Singapore, after all incentives and credits, dips below 15, there can be a top-up to reach that floor. The plot twist is that nothing changes for typical SMEs. The 17% headline and the familiar exemptions still run the show for normal companies. Only the skyscrapers have to worry about the special wind. Personal residency wraps up a set of practical basics. If you plan to live and work in Singapore and spend more than 183 days there in the year, you're generally a resident for tax. Residents use the progressive table. Non-residents mostly use simple flat rules. People like Singapore in part because dividends from Singapore companies aren't taxed in the individual's hands, and because most capital gains aren't taxed. If you're non-resident, salary is taxed at 15% or resident rates, whichever is higher, and many other non-resident income streams sit around 24%. None of this is meant to be mysterious, and that's the point. By now you may be thinking, okay, show me the whole picture in one sweep. Here it is as a story rather than a checklist. A new SaaS company sets up in Singapore. In year 1, it earns 180,000 Singapore dollars. Because it qualifies as a startup, a big chunk of that is sheltered. Most of the first 100,000 Singapore dollars is relieved, half of the next chunk is relieved, and the company only pays 17% on what's left. Call it around 11,000 Singapore dollars of tax on 180,000 Singapore dollars of profit. The effective rate is closer to 6% than 17%. The team expands, a foreign subsidiary starts selling in a neighboring market, and after paying corporate tax there, sends a dividend home. If the foreign country's rate is at least 15% and the exemption tests are met, Singapore lets that dividend land tax-free. The Singapore company then pays a dividend to its owners, and once again, nobody in Singapore taxes that distribution or withholds a slice on the way out. Later, the company licenses a patent from a foreign owner and pays royalties. Now withholding kicks in, unless a treaty says otherwise. So the finance team withholds, files, and pays IRAS on time, all while keeping the agreements and proof tidy. A few years later, a giant multinational with revenue well above the Pillar 2 threshold asks to partner. They care about that 15% floor from 2025. Your SME doesn't need to. Guardrails keep this clean. If you say the company is Singapore resident, run board meetings in Singapore, keep decision makers in Singapore, and document that reality with minutes and signatures. If you plan to bring foreign gains into Singapore and keep them exempt, give the exemption something to stand on: people, processes, and purpose in Singapore. Keep the evidence that makes accountants sleep at night: contracts, invoices, bank slips, tax filings, and, for foreign income, proof of foreign tax and proof of when and where money moved. Handle withholding on time, register for GST when you should, and file the right company return. Many small firms can use the simpler CS form. It sounds basic, because it is. The magic trick is that doing basics consistently is what most systems actually reward. Why does this model work so well? Because it isn't built on tricks, it's built on clarity. A clear 17% company rate with sensible relief for early profits. A territorial base that says, we tax what's here or what you bring here, and then adds a practical exemption and credit structure so you don't get taxed twice. A dividend system that taxes once and lets capital move. Personal taxes that are competitive and predictable. GST at 9% that behaves like VAT should, withholding rules that tell you exactly when to slice and how much, an anti-avoidance spine that says substance matters and shell games don't, and for the truly massive groups, a future-proofing layer that acknowledges the global 15% minimum without rewriting the playbook for everyone else. When rules are steady, companies invest. When results are predictable, people grow teams. When founders can model cash with a straight face, they sleep.